If you want to earn $1,000 a month in dividend income and eventually retire off of dividend stocks, this video's for you. In this video, I'm going to show you exactly how to find dividend stocks that will make you a millionaire over time. And there's a key to it, and it is that you want to own stocks that actually don't pay the highest dividend yield. I'm going to explain what you should look for instead in this video. And then we're going to build a 12 stock portfolio, and I'm going to show you an example of how this portfolio is going to turn into not only $1,000 in dividend income a month, but then $2,000 and $3,000 and $4,000, and eventually be a portfolio that I could live off of with just dividends alone. First of all, at the beginning of this video, I said you don't want to look for stocks that pay the highest dividend yield. What you want to look for is dividend growth stocks instead. Stocks that increase their dividend every single year and over 5 years and 10 years. That's how you get rich off dividend stocks. And this data right here shows you exactly what I'm talking about. This is from Simply Safe Dividends. This is from 1972 to 2017. So a long period of time and before all this craziness of COVID and all of that, right? Dividend growers and initiators, that's the type of stocks we want to find, earned 10% per year. Dividend payers earned a 9.25, so still good. But then if we just went to the equal weighted S&P 500 index, 7.7%. So how can we beat the S&P 500? We can find dividend growth stocks. What we really want to watch out for is dividend cutters and eliminators. And that gets to exactly why we don't just want to own stocks that pay the highest dividends. Oftentimes, those are the ones, if they're not growing their dividend, and if they're not growing earnings so they can pay more dividend over time or continue to pay their dividend, those are the ones that are at risk of cutting their dividend. Here's an example of exactly what I'm talking about. Since 2002, if you would have invested in 3M, a dividend stock everybody's heard of, it would have been yielding 2.13%. Fast forward 20 years, in your yield on cost, the dividend has grown, so your initial shares would be yielding you 16.51%. And then let's take a look at total return. Down here in the bottom corner, we can see the compounded growth of a $10,000 investment in 3M in 2002 to 2022 is only worth $44,399. So it is compounded at 6% and it has trailed the S&P 500. Now let's look at MasterCard. In 2007, you started at a yield on cost, a dividend yield of 0.5%. All the way to today, which is just 15 years, maybe 14 years, the yield on cost of those initial shares are 18.59%, so higher than 3M in 5 or 6 less years. Why is that the reason? It's because MasterCard has grown its dividend at a 42% compound annual growth rate. The dividend growth rate is so much higher than 3M, which only grew at 8%, which is still decent, but only 8% over 20 years. And so now let's look at that total return for MasterCard. This is the other thing. Companies that increase their dividend tend to have better capital appreciation too, meaning the share price goes higher as well. So you get that dividend growth and you get a higher share price. This is a world of difference. 24% compound annual growth rate, turning a same $10,000 investment into $331,000 just 15 years later. If you don't know me, I'm Austin. I'm building a $1 million portfolio right here on YouTube transparently. This is the portfolio right now, $104,239. It is a growth stock portfolio right now. So since February 15th, we are down $14,682. But over the last week, we earned $8,947 because the growth stocks in my portfolio went up a lot over the last week. But I am changing where my next investments are going, and I'm going to do it right here on this channel. I'm not going to sell these, but now I'm going to begin investing in dividend growth stocks. I've made a dividend monsters pie in my portfolio. I'm going to share this journey of building these dividend growth stocks out over time to earn $1,000 a month of dividend. I'm going to show you exactly how. Here's what the portfolio is going to do. I've selected 11 stocks. And what I've looked for are reasonable market caps, right? The smallest one here is a $10 billion company. So you get some safety there, not just some penny stocks or something like that. But most importantly, 5-year dividend growth rate needs to be high because I want to see that dividend growth. And I'll explain exactly why in just a second. The slowest 5-year dividend growth rate we have is Taiwan Semi. Even 20-year dividend growth rate for the ones that have it, we want that to be high as well. And this just shows you, right? So we see these companies that have grown 68% is not sustainable, right? But 18%, 18%, 18%, 15% over 5 years, you would think they can't sustain that over the long term, right? But if we look at the 20-year dividend growth of Lowe's, of Nike, of Parker Hannifin, even of Deere, all of them above 10%. We've got Deere at 11%. We have Parker Hannifin at 12%, Nike at 16%, and Lowe's at 24% dividend growth on average over the past 20 years. I'll cover the rest of the things I look at in just a second, but what this gets us to is we've got these 11 companies. I've put $10,000 in this simulated portfolio. That's what I'm going to invest in each of these over time. And we've built it out. It's got a $109,000 balance, would earn right now $2,249 in annual income. It doesn't sound like much. But if we are not retired and we don't need this income to live off of, we don't want that much dividend income right now because we have to pay taxes on it. We want dividend growth. The dividend yield is currently 2%, which is very respectable. But the key, this is the key, over the last 5 years, 20% dividend growth. One thing I love about Simply Safe Dividends is it gives everything a safety rating, right? We don't want that dividend to get cut like we talked about. 100% of the companies in this portfolio are safe dividends according to Simply Safe. This is where it gets crazy. Let's look at this income forecast. My portfolio's 5-year dividend growth rate is 20%, but 10% is a more realistic rate for a diversified portfolio over longer periods. With dividends reinvested, because we don't need this money now, it's going to give us a 3% boost to the dividend growth. So based on the portfolio's yield, we'll assume reinvesting adds 3% to your growth rate for total annual dividend growth of 13%. So we're looking at this yellow line. Now I've got it set up to be contributing $500 a month or $6,000 a year. We'll assume this money yields 2.05%. That's the current dividend yield, or $123 a year. Now we get to these crazy awesome income scenarios, right? So at 13% per year, currently it's earning $2.2 thousand a year. In just 5 years, we've doubled that. We've more than doubled that to $5,000. By 2032, we're at $10,000 in annual income, which is almost at $1,000 a month. Then it just gets crazy with the compounding. 2037, $19,000, 2042, $35,900 a year just in dividends alone. That's just dividends, right? Let's take a look at what the portfolio value would be over these periods of time as well. All right, we've got our $109,000 to start, 2.05% dividend yield. This is with a 6% share price gain, a monthly contribution of $500, a dividend growth rate of 10%, which I think is conservative, over 20 years, right? We're gonna hit calculate. And so 5 years from now, this portfolio is gonna grow from $109,000 to $220,000. 10 years from now, by 2032, we'd be looking at $374,000 portfolio. And this is where it gets cool. Just with that principal growth alone, you're making $20,000 in principal growth per year in addition to that dividend income. Then by 2041, things get crazy. $893,000 is what it turns into. And then each year, the principal is growing by $50,000. So remember, you're getting paid that $37,000 or whatever it is in dividend income, but you're also getting $48,000 in principal growth per year. This is how you're able to retire off of investments over time, is compound growth like this and time in the market. Now, let's change our assumptions a little bit. We did a 6% share growth rate, but the market on average does 8%, right? So if we move it to 8%, then just these numbers just get crazy. $1.2 million by 2041, you're making $88,000 a year just in principal growth, and then the dividend growth on top of that, obviously. Let's jump back over to this income forecast and let's make a little change right here. Let's say we want to be more ambitious with our savings goal and just be crazy, $1,000 a month, which would be $12,000 a year. How do you get there? Well, over time, try to make more money and save more money. But maybe we pay off a car and we can add $500 a month to our contribution. Maybe we pay off some credit cards or pay off college loans or whatever. And over time, we're able to add another $500. So we're doing $1,000 a month. That's where things just get crazy, right? So same, that 13% per year. Now in 2042, you're making $45,000 in annual income instead of $35,000. Now let's get to those companies. I told you I would show you those companies. We're gonna walk through all of the companies right now, and we'll go by 5-year dividend growth rate, right? Starting with Advanced Auto Parts, again, they're not going to continue that 68%, but it's yielding 3.5%. It gets a very safe rating. 40% payout ratio, that's something to look for. You want to keep it in the low category for most companies. That's how a company can sustain and increase its dividend over time if its payout ratio is low. And then PE ratio, these stocks are all undervalued in my opinion, or close to it, 12. And then free cash flow is positive in each of the last 10 years. They maintained their dividend during the last recession. Broadcom, 43% 5-year growth, 3.6 dividend yield. It is safe. It's not in the very safe, but still safe. 47% payout ratio, a 11 PE ratio. Tractor Supply Co. 18% dividend growth, 1.86% dividend yield. It's in the safe category and a 19 PE. MasterCard, 18% 5-year growth, only a 0.65% dividend, but again, I think we get capital appreciation plus dividend growth for a very long time, and it's below a 30 PE. It's a 27 PE. Lowe's, 18% 5-year growth, 2.3% dividend yield, PE ratio of 12. Snap-on, I bet you haven't thought about this company in a while. 15% 5-year dividend growth, 12-year dividend growth streak, 2.73 current yield, very, very safe dividend according to Simply Safe, and a 12 PE. Parker Hannifin, 11% 5-year growth, 1.97% dividend yield, and a 14 PE. Nike, finally gonna buy Nike, so this is a 11% 5-year dividend growth, 1.38% dividend yield, very safe, and a 28 PE ratio. So that's still a little high. We're gonna start small with these companies and build them up over time, so even if it does go down, still okay with that. Carlisle, again, this company has actually strongly outperformed the market over time. 10% 5-year dividend growth, 1.1% dividend yield, and a 13 PE. Taiwan Semi, I've talked about this before, 9% dividend growth, 2.28% dividend yield, and a 10.7 PE. And then Deere, 9% 5-year dividend growth with a 14 PE and 1.18% dividend yield.